Just a few months ago, the RBA said we'd see at least 3 interest rate cuts in 2024. But according to the latest update, not a single cut is expected until May 2025.
We are not ruling out what we might have to do next.
And the RBA really can't consider rate cuts anytime soon.
Inflation continues to moderate, but is declining more slowly than expected. Data indicates continuing excess demand in the economy. The process of returning inflation to a target is unlikely to be smooth. Those quotes from the RBA explain why they've done a complete 180 on interest rate projections for 2024. After signalling multiple cuts were likely, their latest update shows no reductions until May 2025, at the earliest. Just months ago, easing inflation and a strong job market had experts optimistic for a rate relief this year. But persistent price pressures and excess demand upended those expectations. For property investors counting on lower rates to improve financing conditions, this reversal is a major blow. But as the previous years have shown, opportunities emerge under certain economic conditions. Is this one of those times? Let's look at the data to find out. The update from the RBA is obviously disappointing for investors hoping to re-enter the property market later this year. But as always, we need to consider the full context around the RBA's announcement. I must say, even though there were optimistic expectations of substantial rate cuts early in 2024, the RBA did not maintain a cautious stance. They remained non-committal on potential cuts despite easing inflation levels that led them to hold the cash rate at 4.35% to start the year. In their February statement, the RBA noted that higher rates were working to rebalance demand and supply in the economy. And although signs were encouraging, the board remained highly attentive to inflation risks. Their central forecast showed inflation returning to the 2 to 3% target range by the end of 2025. But they also didn't rule out another potential rate hike, reinforcing controlling inflation was a clear priority. So while investors hoped for rate relief, there were already hints that the outlook could shift. The RBA was unwilling to get too far ahead of themselves amid the mixed economic signals. But what led to this 180-degree change? The RBA's statement in May shed light on the economic forces that completely upended their previous projections. Their updated forecasts now show inflation returning to the 2 to 3% target range in the second half of 2025, at the earliest, pushed back to mid-2026. A combination of persistent service price inflation, rising domestic fuel costs, low unemployment rates, and stronger household consumption growth are largely responsible for these dampened expectations of inflation's decline. Weak household spending is another major factor. With Australians being squeezed by high inflation, many have forced to prioritise savings over discretionary spending. This has directly impacted disposable income levels and consumption. But despite the extreme costs of living pressures from high inflation and interest rates, the property market has shown remarkable resilience. National home values actually increased by 8.7% over the past year, according to CoreLogic. Low housing supply and sustained demand from local and foreign investors are cited as the key drivers of this growth. Home values rose in every state except Hobart, with capital cities enjoying high growth rates of 9.4% compared to 6.4% in regional areas. Perth led the nation with a 21.1% annual increase, fueled by an undersupply of housing and demand from a growing population. So even under these economic pressures and an uncertain outlook, investors recognise opportunities in the property market, and capital values are expected to rise in residential and commercial spaces. Of course, not all asset classes are benefiting equally from this resilient market. Investors actually expect declines in office capital values as the ongoing remote hybrid work debate continues. With more companies embracing flexible workplace models, demand for traditional office spaces have taken a hit. This aligns with the high CBD vacancy rates and subdued investment activity seen in the office sector in Q1 2024, despite rents ticking up overall. The changing workplace preferences of the tenants pose risks to this asset class. So, does this mean writing off the RBA's mixed signals on interest rates? Not quite. While the RBA's latest announcement was certainly a setback for investors hoping for improved financing conditions soon, there are still reasons for cautious optimism. For one, recent data hints at some easing of inflation. even if the declines are happening more slower than earlier projections. The RBA also hasn't signalled any potential rate hikes on the horizons for 2025 as for now. More importantly, the property market's resilience over the past year shows that there's still opportunities to be had despite high interest rates and inflation pressures. Investors are finding ways to capitalise, especially in the residential and industrial commercial sectors. And if we've learned anything from the past few years, it's that periods of uncertainty can give rise to new prospects. The key will be staying nimble and adjusting strategies in the higher rate environment. So while the RBA's mixed signals rocketed short-term expectations, the long-term outlook remains promising for those willing to pivot. Opportunities always emerge for the well-prepared investors. At the end of the day, the RBA's mixed signals show that navigating this rate environment is going to be an ongoing challenge. There's no clear end in sight to these economic crosscurrents of inflation pressures, shifting demand, and policy uncertainty. But don't get discouraged by the turbulence. Keep an open mind, a cool head, and your eyes on the fundamentals that really matter. Supply, demand, population trends. The rest is just noise. The RBA's monetary policy decisions have dominated headlines and impacted all of our investment plans over the past couple years. And I'm certain there'll be plenty more updates and implications to unpack the months ahead. So if you want to stay on top of the latest insights into how the interest rate environment will continue shaping the property market, make sure you subscribe and hit that notification bell. I'll be breaking down all the need-to-know analysis as it unfolds. Thanks again, guys.